We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Skarica, publisher and founder of profitfrompessimism.com, and also the author of the new book called Mega Returns, Profit from Maximum Pessimism, launched on April 22nd. David, welcome to the show.
Good. Thanks for having me here.
So I think we can start with really talking about the book here, understanding that you see this as the end of an era, really the era of asset price inflation and bubbles driven by explosions in debt that has led us really into the everything bubble era here. So you go through different sectors where opportunities still exist simply because of pessimism here. So despite the optimism by much of the electorate with Trump getting into the White House at the beginning of 2025 here, does this overhang from years of overspending still warrant a lot of caution here, David?
I think, first of all, with the overhang of everything, you even remember during COVID, we had all those. Okay, so after COVID, let's just start there because that's kind of starts a lot of this debt crisis. Well, it's really started after the financial crisis, but really like that's what accelerated it. And if you go look, what happened was we had zero interest rates, the trillions of dollars of spending, and the spending wasn't just infrastructure. It was, giving out stimulus checks and the whatnot. And I think those two things prevented a recession from happening in 2022, 2023, when we saw the Fed aggressively raise interest rates, because a lot of people, for example, had already locked in their house mortgages at zero. People still were getting had the remnants of that stimulus money. All of that money printed caused that, that huge uptick in in stock prices. So you had that wealth effect. If you look at 2020, 2021, it wasn't kind of like that last bull market in 2023, 2024, which was mostly the Magnificent Seven. It was like everything, like these little, anything that, like, for example, benefit from someone staying at home because of lockdowns, little streaming companies online, buying your Peloton or whatever, those things all zoomed up in price. So we had that, and now I think it is kind of like the hangover, or the you're coming off the buzz now, because now we've had years of more normalized interest rates, higher costs, and I think you're starting to see the economy kind of hit the wall. And obviously, things like the tariffs in the United States do not help, because that increases the cost of living even more so, and presents uncertainty, which the markets always dislike. I don't even really mention the tariffs in the book because none of this had really started, and we all know that Trump is into protectionism and tariffs, but I think even he has been more aggressive than what most people thought, especially compared to the first term. So I think all of these things, especially the interest rates, I think are the biggest one. You can't go get the 5-year mortgage at 3% now. The 10-year bond is 4.5% in the United States. Mm-hmm. So you can't get these things and then the cost of living too is also a factor on top of that. Because, for example, housing prices are basically doubled everywhere from the States, Canada, here where I live in the Bahamas, from say 2012, and interest rates are now at 20-year highs on mortgages. They're at 7-8%. So it means that everything is more costly. And I think it's really starting to factor in. And of course, the government's not immune to this, because instead of being able to borrow all these trillions of dollars of debt at 1 or 2%, now they have to borrow that at 4 or 5%. And that's why you've seen, for example, the interest payments in the United States go above a trillion for the first time. And now, and this is our big warning sign, it's kind of a symbolic sign, they're spending more on interest than defense. And that's actually when a lot of empires and superpowers actually start to crumble, when they start paying more in interest than they do. Because usually everything from the Roman Empire to the British Empire, they tend to have huge, obviously, militaries, navies, etc.
So, David, let's dig into that a little bit more, if you wouldn't mind. The timing and how you lay some of the actual trades out in the book, I think is actually coming to a head right now with the idea of, we see Japan's rate spiking. You gave us the idea of US interest rates or spending more on interest than defense. So is the timing particularly prescient considering the debt markets right now?
I think, it is precedent. And we were just talking about this off air. The debt markets right now, there's a couple of things going on, which we'll discuss in a second. But I think one of the key aspects of all of this is the governments now are looking in the rear view mirror. Like the reason, you're seeing the U.S. deficit's going to be close to $2.6 trillion this year. There's no cuts. Doge was like a real drop in the bucket. Like it's really nothing in terms of, they just found some outlandish waste. I think it's cut 25 billion, right? It's going to cut maybe 100 billion. And of course, the increases in entitlements will easily eat up that 100 billion in savings, right? So anyhow, we're seeing the government still spend like the bill in the United States, the tax bill and the budget called for $4 trillion in tax cuts in the next 10 years and only 2.5 trillion in expenses cut. So that again, that comes to a net 1.5 trillion. Only 1.5 trillion in cuts. So that's 2.5 trillion in net spending, which roughly ends up being 250 billion a year, which increases the deficit by another 10% a year. So and they're spending like it's the old Prince song, "Gonna Party Like It's 1999." They're spending like it's 2020, right? Mm-hmm. Like it's after COVID and they could borrow at 1%, but no, they're borrowing at a more normalized level. And what's really interesting is we're seeing this happen in Japan. In Japan, I think the 40-year bond has hit multi-decade highs in yield. And of course, the Japanese jet is much bigger now than it was, 20, 30 years ago. And we're seeing, I think even the 1-year bond it's a 10-year bond in the States has gone to about 1.5%, which again, I think is about a 15 or 20-year high. And again, that's at a much higher debt level. And the prime minister actually even warned recently in Japan that they could see a debt crisis similar to what Greece saw, in 2012. And of course, Japan is a much larger economy. And remember, they're doing this in spite of, even though that debt is huge, a lot of the debt is owned by the central bank there. So that's why the net public debt is not as big as the 260%, because I would say almost half the debt in Japan is owned by the central bank. But still, they're seeing these push-ups in interest rates, and you're seeing that around the world. So I think it's not just a U.S. phenomenon; it's a phenomenon, especially in the West. We've spent too much money; we're too far in debt, and I think the market. They used to have something called the bond vigilantes back in the 70s and 80s, and that was like they really used to blow up the bond markets of these third world countries, mostly in South America. That if that's how Argentina and places like that would get their hyperinflations, and the bonds would go to like 1,000%, and they couldn't borrow anymore. And I think we're seeing a bit of that. And I think one of the first instances we saw, I think it was 2022 in the UK. That's when the UK tried to push through that budget. Where they had tax cuts and they didn't have any corresponding spending cuts, and the pound tanked, and the 10-year bond yield blew out, and the central bank had to come in to support, both the currency and the bond. And I think something could be really interesting this summer and fall. I think that could happen in the States in the next 12, 24 months too, that once they push through that budget, people are going to be like, you can't just blow smoke up our, what's with the Doge thing, right? That's all talk. I'm going to see, well, these deficits are never going down. And now we're getting to this, like if that US debt goes to over 40 trillion, which is probably going to the next 2 years, that's getting close to 140% of GDP. Mm-hmm. If you actually look at the OECD, outside of Greece, that's higher, and Japan, that's higher than every single country in the OECD. So basically the US is like a fiscal basket case. It's basically, it would be a banana republic type country if it wasn't the reserve currency of the world.
Mm-hmm. Well, you also go through examples of countries like Canada and Australia. How have those debt levels of those countries grown since 2008?
Oh, they've been actually Australia, and we don't, because again, they're a welfare state, and we consider them like slightly, maybe, we consider them left to center, but they were actually fiscally one of the most well-run companies pre-2008. I think their debt to GDP was only like 15 or 20%. Now, they're still not at crisis levels. I think they're like 60%. But again, the combination of all the government spending during COVID, all the government spending, after, even though Canada and Australia weren't affected that much by the financial crisis, like they're actually Australia didn't even have an economic contraction during the financial crisis. So, but still, the governments did spend during those crises. Again, money was cheap. So Australia has really been hit, and same with Canada. We all know the larger deficits. And one thing about Canada we have to take into account is the provincial, debts as well, because the provinces kind of run themselves in Canada. And for example, I think Ontario has the largest government debt, independent government debt, like basically the largest provincial or state at the state level debt in the world. I think it's even larger than California. So you have to factor that in. Like the debt to GDP in Canada may only be 60 or 70%. But again, you factor in all those provincial deficits, it's probably well over 100%. And the main issue in Canada and Australia actually isn't so much the government debt, it's the private debt, because both of those countries have smaller populations, and they've had those huge housing booms driven a lot by immigration. And if you go look at it, like the private debt to GDP in Canada and Australia is astronomical. It's like 170 or 180%. And I think at the top of the bubble in the US in 2006, the top of their housing bubble, in the US, it was only like 130 or 140%. So that's the issue there. And as you know, I think you're in Canada, right? You're in Alberta, right? So, well, and hopefully Alberta won't be part of Canada soon. So, but what I'm trying to say is those debts are really the problem. And the favorite mortgage in Canada was a 5-year fixed. Well, now we're into 2025 and 2026. So those zero rates of 2020 and 2021, a lot of those are going to have to be rolled over. And those people are looking at, like paying 6 or 7% instead of 2 or 3%. And that's going to, I know I have a cousin, he's not rich, he's like a cook, and I think his wife is a nurse. And I think he's almost going to be forced to sell his house because of that, because he won't be able to afford it.
So, David, who can bail out the governments like, let's say, China or the US when another downturn eventually occurs here?
Well, I think there's going to be a lot of interesting factors going forward. I know a friend of mine has told me, like, they have this he says that Bessett and these guys, they have a whole plan of like kind of revaluing everything, which means, for example, almost like when Nixon went off the gold standard, like what they want to do is they want to like revalue gold at 15 or 20,000 and then actually sell the gold there and then use that to pay down some of the debt. But I told him that the problem with that philosophy is twofold. Number one, inflation will be very high, so why not just pay off the debt with worthless and faded money other than real asset like gold? Mm-hmm. And then number two, at 15,000, the U.S. gold reserve is only worth $4 trillion, so it's only 10% of their gold. So realistically, you'd probably need gold at 70 or 80,000, because that would make it worth 20, 25 trillion, and then you could pay off a good chunk of the debt. But again, at 70, 80,000, we're going to be in some form of hyperinflation. And again, I'd rather just pay off the debt with that hyperinflated, worthless money than, again, sell a real asset, right? Because remember, when you come out of hyperinflation and you slow down to regular, okay, the gold price regular inflation, the gold price comes down in nominal terms, but it will hold its value, right, in real terms. So it's like you want to still keep that on the books, in my opinion, right? So I think we're going to have a lot of printed money, and probably we will need a reform of entitlements. And in terms of other factors, China is now slowly selling off their U.S. bonds. They are now actually only the third largest holder behind Japan, and the UK recently passed them as the second largest. So China's slowly getting out of their U.S. bond positions and bringing money home. And again, Japan, the issue is they own 1.1 trillion in U.S. debt, and forget like them selling it because, say, they're angry at Trump or trade wars or anything like that. They may be forced to liquidate that debt to bring the money home to, again, pay off their own debt or to keep their own rates lower, or even do a stimulus if they're in a bad recession. So I think this forced liquidation, and that's the flip side of being the reserve currency. It's great on the upside, when everyone's got to buy your debt. But it's brutal on the downside, like that, when 8 trillion of your debt is owned by foreigners. Mm-hmm. And if those foreigners in a bad economic downturn are then forced in turn to, sell that debt and bring the money back home. And I think that could happen. So, but I think in the end, the main thing is, and I talk about this in the book, that's why I have so much on gold and silver, is that they're just going to print money. And I think that what will happen, if I'm correct, in a crisis, you'll see the bond yields blow out. Right, like I'm saying, maybe that 10-year bond in the States goes to 6-7%, and that essentially makes the government on paper insolvent. And then they'll have to print money. They call it yield control to buy that bond to bring the yields down. So what they'll do is they'll print money to try to keep those bond rates kind of where they are now, say 4%. But they're printing money to do it, so it's going to be super higher inflation with them printing money to try to keep the yields down. It's a bit of a catch-22.
Mm-hmm. David, I want to go back to what you were talking about the Treasury basically having to sell the gold to recapitalize the balance sheet, let's say.
Yeah.
What if they just marked it to market at let's just use a round number for at $5,000 or $10,000 an ounce, wouldn't they be able to, basically print based on that instead of actually having to physically sell the gold?
Yeah, I think you could do that. But again, the issue is if you're actually trying to pay down the debt, you need like I don't know, maybe you could issue a bond that is backed by the gold, right? And then just say this is a special bond, but it's still more debt, right? Or something like, or even and then you just do that to pay off down the national debt, or that bond might have lower interest because again, it's backed by gold, and that's a way to replace, say, 10 trillion in debt that's yielding 5%. Maybe the gold backed bond only yields like 2%, and it helps save the government money. But I just think there's no easy way out of it. Like, what really needs to happen is, like, the problem is this is all financial shenanigans to me. Is that I'm a libertarian politically. We need to reform all of these. Like, being a libertarian, I don't care about any of these entitlements. Like, I know I'm Canadian, and Canadians supposedly love their universal health care. I'd like to see that whole system privatized. So, but that realistically is not going to happen. But you're going to need to redo the entitlement programs. I think that maybe the pension programs could be privatized. Like in Chile, for example. They have a private system where you just pay into it. You buy like an equity and bond fund and like an account, and you pay into your own account rather than paying into Social Security or Canada Pension, et cetera. So I think those are going to have to be reformed. So I think a combination of printed money, reforming entitlements, all of these things are going to happen if we have a debt crisis going forward, right? Because, like, for example, an example like this happening was, after World War II, when the British Empire essentially was bankrupt, the empire imploded, right? Like the cost of maintaining India and the Caribbean and all these places was astronomical. And the British didn't have the money to do it anymore. So, all the country, I live in the Bahamas. The Bahamas became independent in the 70s. Jamaica became independent in the 60s, I think. So I think you're going to see like those kind of things happen when you can't, afford your bills. Like the U.S. spends, like I said, $1 trillion. Well, what happens if the U.S. just decides, well, we can't afford that trillion. Now we're going to spend $500 billion a year on military, and all these bases offshore or overseas are going to close. So I think those are the type of things that will happen but I just don't think you can get out of it unless you have massive printing of money, and basically you have to inflate it away. That's I hate to say that, but I think that's, again, all these other things. It's just the debt has gotten too big. And by the way, last thing I'd like to say, and you saw this in the Canadian election, you saw this in the U.S. election, even though it kind of did come to the front a bit with Doge. No politicians really talk about this stuff, right? They don't really talk about, we're probably going to have tough. I think a real politician, but none of them are real, would say we're going to have really tough years ahead because we have this huge debt, and we have to find a way to solve this debt problem. And it's tough to have a booming economy in society when your debt to GDP is 120, 130%. And actually, just to revert back to that debt, just to say, the reason I think that U.S. is so close and key is that most of the studies have shown, and Ray Dalio, the famous hedge fund manager, did a study on this, that 130 is about the line in the sand. And when you go over that 130, that's when most of these debt crises start. Like some countries have been able, like Italy's been at 130 for decades. And, the European Central Bank kind of buys their bonds. So sometimes you can stave it off. The British had about 150 after World War I into World War II so basically 20 years. And again, they were able to stave that debt crisis off because they were the reserve currency. So maybe the U.S. will be able to do it. But the problem, is entitlement spending. When the U.K. had that debt, it was just because of the war and the empire, right? UK had no social programs back then. So the problem you're going to have is Medicaid, Medicare, Social Security. They're all going to boom in terms of the amount they cost. So I just think there's no way out other than printed money. And that's why I'm so positive on gold and silver, right?
David, we've talked a lot about basically government and, let's say, public debt, but there's a lot of corporate debt that's also maturing by 2027, $2.6 trillion, as you say in the book. So what specific triggers could cause a wave of downgrades and defaults in the corporate sector as well?
Well, the problem with the corporations, they have very little leeway now. Okay. So like, let me give you an example, right? and I talk about this in the book, and this is 2019 that Jeff Gunlock talked about this. He's the biggest bond manager in the world. And he basically stated that if corporate interest rates normalize. So right now, I think the average corporate bond is like around 4 or 5%. I'm going to go look at the yield of the LQD right now as we're speaking. Like the LQD, for example, yeah, it yields 4.4%. That's the investment grade corporate bond ETF, right? And I'll talk about that in a second. So if it's like 6 or 7% is the normal, well, if you normalize to 6, 7%, and remember the LQD at one point, or these corporate bonds, they were 2 to 3% during the lows of interest rates on average back in 2020, 2021. So if you went to that 6, 7%, something like 3/4 of corporate investment grade bonds, so the highest level ones, would actually be junk because these companies have taken on so much debt that that increase in interest expenditure would eat a ton of their revenues and into their balance sheet and profits, et cetera. So that's something to look at. And like you said, that has to be rolled over. It's already going to be rolled over at higher prices. But also the difference between corporations and the government is, okay, let's say there isn't a government debt crisis. Let's say the usual trade comes back. People buy the government bonds. The yields go down in a recession, like what happened in 2008, like what happened in 2020. But let's say, but that happens, corporate bonds don't have to follow that trade. In 2020 and 2008, corporate bonds tanked. And why? Corporations make less money in a recession. They have bigger losses. It's tougher for them to finance the debt. People don't look at them as a refuge like they do government debt. So even if interest rates were to go down at the government level, if there is a recession, and like you're saying, they have to renew all this stuff, and they might have to renew it when they're, Walmart's already talking about they're going to have a tough time because of the tariffs. So, and they have to renew this debt, with revenues going down in a weak economy, that could blow the whole thing up. And people might just ask for higher yields, even if inflation isn't bad in a recession. They could say, "Well, we want 7% because you're a riskier investment now." And so the trade I have on this in the book is just quite simply looking at buying put options on the LQD, which is the investment grade corporate bond ETF. And what's great about this trade is two things. So the first part of the trade is what I just said. When you look at what the guys did in The Big Short, if you watch The Big Short movie or whatever, what the guys did, they were looking for mispriced assets. So mortgage-backed securities were all rated as AAA, and they were garbage. They were junk, right? And that's what those guys found, and that's why they shorted them. And because they were also leveraged garbage, all went to zero. So that's why they made so much money on that trade, because it was a mispriced asset. It was something that was priced like it was a quality asset, and it was really junk. Well, if corporate bonds, like I said, if 3/4 are really junk, if interest rates normalize, that they need a readjustment in price. And the one thing about corporate bonds, investment grade, they're usually very, very stable. They trade like at a 5 to 7% volatility a year. So if all of a sudden you get a blowout and they fall 20 or 30%, what you'll find in the options, the implied volatility of the LQD puts is very low. It's like 5, 6%, right? And for example, most options have like for example, something like NVIDIA will have applied volatility of 40 or 50%. So that just shows you how low it is. So I'm just looking right now, for example, the June 2025 puts, and the LQD have about 8% implied volatility, right? So that, like I said, they're very low. And for example, if you get a 20% decline in the LQD, these could really, really blow out, in terms of the yields. And then you can make usually on an option trade on a put, you're going to need the stock to fall 70, 80% to make, say, 10 times on your money. But with this trade, you probably only need the LQD to fall 20%. Now, as a warning, because it's not the overly heaviest traded asset, the puts aren't overly liquid. I do have to warn you on that. So there's two ways you could do it. If you're someone who doesn't really want to play it too closely, you could buy the January, say, 2027s. That gives you a year and a half, basically, and just a couple percent out of the money, and just forget about it and see if something happens over the next 18 months. Or the LQDs seem to be a little more liquid as you're closer. Like, for example, you could buy a June 103. The LQD trades at 106 right now for 17 cents. So you could just put a tiny bit of your money and say into something every quarter, right? Like June's obviously, that's a month away, but you could have, say, bought those in March. And then if expires worthless, you could just buy, so you could do a smaller amount of money and just keep doing it and keep doing it. And then at some point, if you get this trade blowing up, the premiums will blow out, and you'll make 50 times on your money, and you won't care about those. Even if you lost 10 times before, you'll still make 5 times on your money at some point. So you could look at doing something like that,
So,
And
David,
by the way, that's something I would do with a very small part of your portfolio to hedge, like 0.1% or 0.2%, something like that.
well, that's a perfect example of these, tangible, actual trade ideas that you have in the book.
Yeah.
I appreciate you lay out the book in a really interesting way, from not only the theory that we're kind of talking about and the, let's say, the macro setup of a lot of these things, but also giving actionable ideas based upon those premises that you lay out very clearly. So,
One thing, just like I give an example in the book. I used to trade options on Sotheby's a lot. The ticker was bid when it was traded. It got taken private, and the reason I used to trade bid so much is that was a highly leveraged stock to the economy. It's it's high end auctions, right? It's fancy jewelry, it's paintings, it's like rich people, and of course when rich people own all the assets, so when stocks go up, they're richer, and Sotheby's tends to do well. And the recession, Sotheby's tends to do very poorly. And Sotheby's had this huge thing, like it would go to like $5 or $10 in a recession, and then it would go to $50 or $60 in a boom. So it was a great trading mechanism. And I talk about in the book how Sotheby's was taken out. And if you would have had a straddle, so you would have had a put and a call, you would have made like 3 or 4 times your money on the trade, because your puts obviously expired worthless. But when that takeover happened, your calls made a fortune. So that's another strategy I talk about just quickly to finish off on that point is like I talk about Microsoft, for example. Like if you do a straddle on Microsoft, if Microsoft goes up or down more than say 20% in the year, one of those 2 sides of the trades is going to make money and make up for the fact that the other one goes worthless, and you'll still come out ahead. Now, it may lessen your profit. If Microsoft, say, collapses in a stock market crash, your calls are going to be worthless, but at least you're going to make money either way. But what you need is a little bit of vol. If Microsoft just sits there and goes sideways, it's not going to work. But for example, right before we talk about the next thing, Microsoft this year, for example, the first quarter of the year into early April went from 450 to 350. Now it's back at 450, and so that's great volatility. Like that's something you could probably, like if you would have had, say, puts and calls straddles like that, like expired, in June, say you bought them in July, you might have made money on both the trades, right? Because the stock fell in April, you could have sold then, and then your calls now would be making money. So there's an example.
David, you highlighted gold and precious metals as hedges here, and some say that gold has moved too far too fast. Do you still see this as a buying opportunity, or is this part of the everything bubble at this point?
Here's the thing about gold. Okay, it's like it's hard for me to get like super bullish or like want to buy everything, head over heels or whatever, hand over fist, when like I've been in gold since 300 in 1999 when I started, right? When it's 3,000, it's tough to get like that. But if you go look at gold again, compared to the Dow, compared to the Fed balance sheet, it's still, not expensive. Like I talk about the gold to S&P ratio or the gold to Dow ratio in the book. And, both times gold had major tops in the, or in the stock market, major lows in the early 80s and early 30s. This is very long-term cycles, went to about 1-to-1. Well, 1-to-1 now is gold's 40,000. So let's say they meet because the market goes down 40-50% and gold goes to 20,000. So 20,000 is still 6-bagger from here, 6-7-bagger from here. So I definitely think you can buy it. I'd be more selective, only buy the dips. Like I think this 3,000 to 3,100 was an excellent, or 3,000 to 3,200 is where you should be buying at the moment. And what's interesting now is, even though they've done nothing for 20 years, I think now it really is time for the gold equities to shine, to literally shine, because their costs have all kind of come in line. Oil prices are low. That's one of the biggest input costs. And you've seen it. Like some of the companies I own, like I'll give away one of my stock picks. I own a small silver miner called Avino Silver. And that thing has been absolutely on fire. Like we probably bought it at like $1 in the letter. And one of my accounts is almost $3. It's a small producer. And it's the perfect kind of company I like, in that it's a small cap production. It's small cap production, and they're bringing on a new property. They just brought a new property, so small production with the ability to expand and controlled costs, not diluting too much. That's the kind of company that, if you get silver doubling from here, this company could go to, it's $3 American right now, about that. This company could go up much, much higher than like a double from here. So that's the kind of thing I really like. And by the way, just to finish off on that point as well, you're talking about gold, you still want to buy. I don't think it's part of the everything bubble yet. I would rather buy silver here because, again, the gold to silver ratio is over 100 to 1. And that only happened one time in the past. And that was during COVID in March, April of 2020. And silver did fantastically over the next year after that. So I would actually prefer to buy silver here.
Do you still consider it really a currency hedge or monetary metal? And when does that role start to switch, if it does?
Well, I think, yeah, silver has more industrial uses. That's why it's lagged, I think, gold here. Because I think, again, to get back to the point we talked about bonds, I think that's something else. Look, even if foreigners aren't going to dump their US bonds, they're not buying anymore. And a lot of it's not even the economics that I talked about. I'm sorry if people don't want to hear this, especially the Americans listening to this, but Trump has pissed off the rest of the world. That's why tourism to the States is plunged, right? He's like, and I don't blame people in the rest of the world acting in this manner. Like, this guy's calling you losers and saying that you're ripping off the US and this and that. Like, you're not going to turn around and buy that country's bond, right? So I think that's kind of what's happened here. And I think a lot of that money that maybe sovereign wealth funds or central banks would have bought in US bonds are going into, that kind of money is going to go into gold, not silver. Silver is not a big enough market for it. And I think where silver really takes off, it's a combination of, people finally look at it as a currency. Like, silver is basically your change. It's your cents, and gold is your dollars, right? If you want to put it in that terms and those terms. And then also silver is going to be where the retail people go, right? Like, I think that when you get a drawdown in the stock market, and you saw crypto, Bitcoin correct from 110 to 80 during this correction, it's like when you get this like correction, if you're a bear market, I think Bitcoin will drop 30 to 50% again. And I think a lot of that retail money that, say, plays crypto, silver's that volatility. It's the kind of asset that would actually attract a lot of that money. And I think that's when it can really outperform. So it'll be a combination of people saying, yeah, silver is a currency hedge like gold, and it's for us small guys, right? And I think it's gonna, like I said, attract some of that hot money. Like, I think the junior mining stocks at some point will do that as well. It's taking forever. But again, I think one thing that's really hurt junior mining, and by the way, the CDNX is breaking out of a 3-year base. But I think one thing that's really hurt junior mining as a whole is the fact that, like, the millennials and the Gen Zers, they play crypto. But I think that, again, if crypto sees a drawdown like it always does in these bear markets, the juniors will catch a bid.
Of course, when we think about, let's say, the precious metals complex, David, platinum and palladium are part of that. But how do you see the demand picture and the outlook for platinum and palladium going forward here?
Well, they're going to be interesting because, a lot of palladium is used in catalytic converters. And of course, there's this move to EVs. So that could hurt it. But the thing about platinum and palladium, it is also kind of a supply side story, because there isn't a lot of pure platinum and palladium. They're actually breaking out today, by the way. Just as I'm looking, actually, like the Sprott Platinum Trust as we're talking, and it's up over 2.5% today, and it's breaking out. So, and then again, if you use these ratios that I use, first of all, platinum and palladium seem to me to be a safe trade, and that, again, all through 2024 and the first half of this year, which we're roughly almost halfway through the year, like they've just gone sideways, right? So it's kind of, I like those kind of bases. There's just another term. It's a simple term. The longer the base, the more the space, meaning the longer that something builds that base, when it breaks out, it's going to go higher and stronger for longer. So anyhow, that's kind of where I'd like. And again, I like them more the supply side story, because they're, because they haven't gone anywhere for a while. They're not sexy metals, and really there isn't a lot of pure producers. Like, most of palladium production comes from Russia, and Russia tries to control the price. Like, they'll tank the price to put the foreign producers, I mean foreign to Russians, like outside of Russia, out of business, and then they'll constrain supply in Russia. So then, when Russia's controlling most of the supply, they'll let the price run so they can sell it, and make huge profits on it. But yeah, I like platinum, palladium down here, like I said. And also, if you do believe we see some kind of inflationary spiral because they have to print money in a debt crisis, really every metal, even if the economy is not overly strong, even copper, which is very, economically sensitive, these are all going to run. We're going to see inflation. It's like we've seen this kind of rolling inflation in different assets, like even egg prices have spiked, cocoa prices have spiked. So I think that's what happens. And if you go look in the 70s, for example, sugar actually peaked in 1974. There was a huge spike in it, where most commodities peaked in 1980. So there's this kind of like rolling, inflationary trades where some asset will do better than the others. But yeah, I like platinum and palladium down here. Like I said, I think, again, when you buy an asset, and one of the themes of the book is maximum pessimism, buying things cheap, you have to think to yourself, how much can go down? Like, for example, I'm looking at the Sprott Trust as we're speaking right now, and it moved from 2016 from about $6 to $20 in 2021. And now it's $10. So it's 50% off those highs of 2021. And it's been basing at $9 to $11 for almost a year and a half. So I like that. The risk reward seems pretty good there.
Mm-hmm. David, is much of the commodity sector potential here you see based around exactly what you just said? The fact that commodities are basically at the cheapest levels compared to equities, and this reversion to the mean needing to really re-exert itself.
Yeah, I think that's exactly it. That these things all move in cycles. And I guess the thing that surprised me, and the thing I ended up being wrong about in the last 10 or 15 years, was that I thought in 1998, I wrote my first book called Stock Market Panic. And it predicted like that gold and commodities would boom and equities would lag. And that's what happened for the next about 13 years or so after that. And what I failed to see is I thought, and I think maybe this might just be a big consolidation. Now, I know that 15 years may seem like a long time, but like if you look at commodities, I think and we are closer to that topper end of the CRB. But again, CRB compared to the S&P is low because the S&P has gone up so much more. But it's like to me, it's almost like what I didn't foresee is that when they printed all that money after the financial crisis, I was still bullish on commodities. And what I failed to see, and I made a mistake, and I admit my mistakes, is that all that printed money and that cheap money went into equities, stock buybacks, all companies could borrow cheaply, all of these things that caused this big equity bubble. So, but I think now we're going to see more real inflation. And another thing I talk about in the book, like that money is going to go into commodities, is something called what I call hypernormalization. So it's a documentary by a guy named Adam Curtis. And it's a term that kind of was invented during the Soviet Union in its latter days in the 70s and 80s. And what it was people in the Soviet Union knew that their system was failing and there was something wrong. But they, obviously everything was state control and they were told everything was good. But people can say, "Oh, the Soviets are all brainwashed, whatever." But no, they knew what was going on, right? They knew things were going poorly. That's one reason to collapse, because the system wasn't working anymore. And I think we're seeing a version of that in the West, where you go to one of these expensive cities like Toronto, Vancouver, New York, London. It's all the same thing. There's all these buildings that are empty because foreigners own it. So it's not trickling down to the economy. Even though we have all this technology, we have AI now, we have 3D printing. Things aren't getting better for the average person. We have all this high inflation. We talked about housing costs, and people know something is wrong and the system isn't working. And where this comes into what governments are, is I don't think you're going to see financial engineering to pump asset markets in the next kind of downturn. You're seeing the return of political power. So what's happened in those years I've talked about is the technocrats, the people in Silicon Valley, on Wall Street, those guys who really run finance have run the whole system. But what's happening now, which I really like to say, is that we're seeing the return of political power. Carney, even though I don't like him, he has talked about doing all this stimulus, right? Government stimulus. I just saw Doug Ford say that as well. In Europe, you're seeing Germany rebuild their military. Trump is using tariffs as a way to use political power to try to, regain some industry or manufacturing. So I think that's what's happening during this, with this hypernormalization, is that people realize that allowing the technocrats, allowing the people who have driven these asset bubbles to drive society and economics has not worked. And that now we're going to go back to trying the politicians and let them take a little more control. It also means the return of nationalism, all of that sort of thing. Like Canadians are pretty mild-mannered and not nationalistic. And, you saw that, maybe they were stupidly nationalistic during the last election, but they were much more nationalistic and kind of responding to what Trump was saying, 51st state and all that stuff. So I think that is, and that's all actually part of this commodities trade, because if governments take control, that means more infrastructure projects, more big projects. Just think, for example, the Hoover Dam during the Great Depression, how much steel, concrete, et cetera, was used to build that, right? So that's what I kind of see happening. And this hypernormalization and this kind of failing of the asset bubbles to really improve people's lives will lead to this more political power and like that sort of thing. And you're going to have to print money to pay for a lot of these things too, which again will help commodities.
Mm-hmm. David, we've seen a fairly muted oil price right now, and if the world is facing, a global slowdown, basically, do you see opportunities yet in oil and gas and, let's say, agricultural commodities as a derivative of that energy price as well?
Okay, so with oil, I am still waiting. I had a bunch of oil investments that I kind of sold because it just didn't look appealing to me. Luckily, I moved them into a lot of precious metals things, right? So because I was like, you know what? There's this range of like the 60s to the 80s going on in oil. It's not cheap, it's not expensive, but it's just not appealing here. And we have all this record production in the United States. The United States makes 13 million barrels equivalent a day, which is a record of any country. Even Russia and Saudi Arabia each only do about 10. So I was like, you need to me as almost like a washout to get rid of some of that production and some of the stuff that's uneconomic and profitable. So I'm kind of muted on oil right now. I do think we are going to get a recession, and that could drive oil back into the 40s. At that point, yeah, I would definitely be buying aggressively. Right. So I'm kind of like more muted on oil right now. And also, too, if you look again, what's going on, Saudi Arabia and Russia are keeping production high because I think they're trying to bankrupt the frackers and again, get back to debt. The issue with all these frackers is they're run by debt. And again, why was there a fracking boom, right? In the 2010s and early 2020s? These companies could borrow very cheaply. Well, again, that cheap money is kind of gone. And with oil lower, that makes them their rates even higher because they become higher risk, right? So I think there's also that effort to put a lot of the frackers out of business. And like I said, they're very vulnerable because they are so highly indebted. So I would wait a little bit on oil. And obviously, too, the problem now is Carney's in power. Hopefully, it's one of these minority governments only lasts a year or two, because if the conservatives get in power, I do think you can see pipelines built, and that would really help the oil sand companies. Like a company I really like, which I don't own at the moment, is Athabasca Oil. It's a oil sands company. It's like a mid tier. It's about $5 a share. I bought it at 10 cents when it was almost bankrupt in 2020. Sold it at 50. Thought I was a genius. Then it went to $3, and I rebought it at $3, and then I held it to about $5 where it is now, where I sold it again. So, but this again, I like the smaller mid-range companies because if that oil from Alberta can really get unleashed via pipelines, then the production can soar in these companies. But we're not there yet. And like I said, I would like to see one more downturn, maybe in an economic recession. The only issue could be, again, is do we see a short-term deflationary bust that is followed by all this printed money, or do we just see stagflation from day one? Mm-hmm. So that's what we're going to have to see. But like I said, I would like to see one more downturn in oil before I really buy.
Mm-hmm. How do you balance the risks of over-leveraged oil companies with the potential for price rebounds, David?
I just kind of look at the balance sheet. Like, one reason I was bullish on Athabasca when it was 10 cents, I looked at their balance sheet and their production, and I was like, I don't think they're going to go bankrupt. Like that's the thing you have to do. See, when you're doing these maximum pessimism plays, one issue you can find is you can have that quote unquote value trap where you're like, wow, this stock's only trading at a fraction out of its revenues. But then you realize, oh, they have all this debt and they're going to go bust in 2 years, right? So, or their sales are collapsing. So you have to like look at the balance sheet and be like, just quite frankly say, is this going to like be able to survive? And that's what I saw in Athabasca when oil, went to those low levels of 2020. And like I said, I foolishly didn't hold, like, I could have had a 50 bagger, if I had held on. And that's another difficult part, is that when you buy something so cheap and then it goes up a lot, you're kind of, want to sell. But so I always tell people to do these things both on the buying and selling tranches. So if you want to position in a company, if you don't get the whole position, it starts to move, fine. Buy, 20% of it here, 20% of it there, et cetera, et cetera. And then same thing when it really starts to move. Like what I should have done in Athabasca is I should have just sold 20% of my position at 50 cents, got my money back, and just let the rest ride, right? So, I really, that's my two things are, like I just said, can the company survive? And number two, do they have a catalyst to turn around the business? Right? Because you said over leverage, like you need a catalyst. And you could see in 2020, the catalyst is going to be, well, this is an oil company. And what's the catalyst? Very simple. They're printing and borrowing trillions of dollars for COVID. And at some point that's inflationary and oil prices are going to go back higher. So you need a catalyst. The last thing I'll talk about this is one of the most famous trades with this is John Templeton. He bought 100 stocks under $1 in the 30s. I talk about this in the book. And his thing was a lot of these companies were railroads that were in bankruptcy because of the Great Depression. But his catalyst was, he was like, okay, the war is going to start up. The US is going to basically, build the militaries and equipment for Europe to fight the Nazis. And that's going to get the railroads moving. That's going to get industry moving. And these companies are going to basically be able to turn around. I'll give one more example that I did myself personally. There's a stock called Fubo. It is a streaming service. And I'd been buying this thing since for a year or two, around $150 a share. And it spiked to nearly $6 earlier this year. And first of all, they were trading on a big discount to their revenues. They had a lawsuit against Disney. Basically, there was a special sports package that Fubo was asking Disney and Fox and these other companies to do. Then these companies turned around and launched this sports package on their own. And Fubo said, no, we've been asking for this for years, and now you're doing it without us. So they were probably going to win that lawsuit. And so I saw the potential from the lawsuit. I saw that their own business was still strong. The revenues were growing 20% year over year. So I saw this catalyst for this company to turn around. And by the way, they made a settlement with Disney, and that's what caused the spike to go from $1.50 to $6. It's about $3.50 now. So I just want to tell that story because that's what you have to see. Because like I said, like there's other companies that I still have on my watch list, and a couple of them I really haven't owned for years. They haven't done anything for years because they're cheap, but they don't have catalysts.
David, you wrote an entire chapter on emerging markets and real estate. So why do you view a country like India as a standout long-term investment compared to other emerging markets like, let's say, China or Brazil?
Well, because I think, number one, from my political stance, like I try not to involve politics in my trading, but like I'm not a fan of China and their system. And I think, like, again, you have to also take it like realistically. Like, I don't think China is the West's friend. Look what happened during COVID. And India is kind of like the counterpart. It's kind of like you talk about the Soviet Union and the US, that if these two countries continue to boom and become the new superpowers, is like India is going to be basically what I think America was, as opposed to China, which is kind of maybe what the Soviet Union was, right? So we kind of need India to succeed, but also India has much better demographics than China. A lot of production, Apple has moved a lot of their iPhone production there because the cost of doing business now is cheaper because China's, GDP per capita is like 3 or 4 times the size of India. So that means India can grow 3 or 4 times per person. And that's why India now has overtaken China. Like China's only growing at 3-4% a year now, and India's steady around 6%. And, they kind of have a lot of Western accounting standards that the British brought there. A lot of these key companies like, Land Rover and Jaguar are owned by Tata, the auto company. So are actually based in India. A lot of the companies trade, like Infosys, on the U.S. exchanges. So they have all these aspects. I think we're long term, they're going to continue to grow. And I think it's like the ETF I use, the IFN. I actually have a video up on my Profit from Pessimism YouTube page if you want to look at it. It's called The Only Investment You Need to Make. I think it's one of my most viewed videos as well. And it's just the IFN, which is Indian ETF. And what's interesting about that ETF is they pay out the capital gains every quarter as a dividend. So when you have a year where things go up a lot, this thing can pay 10 or 15% dividends. And if you actually adjust this ETF for those dividends, it has outperformed the S&P, including the S&P dividends over the past 25 years.
What about another country like Argentina? What makes that country attractive to you now as well?
Again, this would be kind of like a company that's turning itself around with Milei. And I consider Milei to be much more of a real kind of libertarian conservative than Trump. Mm-hmm. Like he's slashing government spending. Like I think the whole thing with Doge is a joke too, because you don't need 100 computer dorks and nerds, engineers to go through all of these things. You just Department of Education gone, this department gone, this gone. That's what you need to do if you're going to really reform the government, and that's what Milei's done. And also he has a good relationship with Trump. So that also what that means is I think they're going to get exemption from tariffs. Even Argentina actually has quite high tariffs themselves, because no one in Argentina pays income taxes. They're on the books, but no one pays them. So they have to, that's the way the government makes money is through tariffs. But yeah, I really just like the reforms. I have an Argentinian stock I really like. I'm not going to mention it because some of these I do have to keep for paying subscribers. But again, this stock yields about 8-9%. It owns a lot of malls and real estate in Argentina. And what I really like about these Argentinian companies, now that the company is pro-growth and pro-capitalist, these companies survive through 20, 30, 40 years of garbage and hyperinflation and socialism, and this sort of thing. And so these companies are very well run, right? And they couldn't be dependent on cheap money because there was no cheap money in Argentina. Argentina had hyperinflation and hundreds of thousands of percent, right? So I really like Argentina going forward. And that's a little different than India, where India, I think, is a long-term growth story. Argentina is kind of more like a turnaround play. And also, you look at Chile's moved a bit to the left. Colombia has their first ever socialist government. We obviously know that Brazil has a socialist government at the moment. We know that Venezuela is a disaster. So what I again kind of like about Argentina, it's kind of like the only country that's moving to these free market ways where everyone else is going the opposite way in South America.
David, you've put some emphasis on looking at new technologies, AI, 5G, 3D printing. This entire sector seems like it has gotten overheated and is high risk, but it's also, possibly high reward. So is there still opportunity in some of these high tech sectors?
Okay, well, 3D printing is really cheap. Unfortunately, I just got stopped out on one of my 3D printing deals, but one is there's two companies I talk about in the book, and one is doing extremely well, and the other one not doing so well. But most of these companies are off 90 or 95% from their highs, and the FDA recently approved 3D printing of dentures. You can 3D print auto parts. Obviously, with tariffs on everything, that actually makes the 3D printing of auto parts, for example, more appealing. So there's all these ways. So 3D printers, I think there's a 3D printing ETF. I would buy a basket of these, and you could forget about those. I think they will go higher. And by the way, they're a warning sign, though, because they were the hot sector in 2014, and most of these stocks fell 90 to 99%, right? So that's number one with 3D printing. And then with AI, yeah, these stocks aren't cheap. Obviously, NVIDIA is the leader. A lot of these other things, have gone up. We had the, kind of the typical bubble where you just said you were doing AI and your stock spiked. So with the AI stocks, again, you could have bought Amazon after it fell 95% in 2021. We all know what Amazon has done. I think adjusted for the split, it was 25 cents at that bottom in 2001, right? And, go look what the stock is now. You made a ton of money. And again, post split, the high was about $5. It went from $5 to 25 cents. So I think that's where AI could be, is that a lot of these stocks, at some point when we do have a bear market, they're going to fall 80, 90, 95%. Some of them will probably disappear, but that's when you're going to kind of want to go get in AI, because we all know that AI is still going to be just like the internet was 25 years ago, the technology of the future, et cetera. Like I have to say, even now when I do PowerPoint presentations, I use those AI sites and they're excellent for that sort of thing. And there's even all these AI adult sites, and it's just going to change. There's going to be, when AI gets really realistic, they'll probably start making movies that are just AI, right? They don't even need to hire actors. Like you're going to see a lot of things that it's going to change everything that you do. And yes, but I think right now stocks are too expensive. And you got to wait for that. Like for example, during this correction, Nvidia went from 150 to 90, so that's 40%, and the stock market fell about, I think about 18% is what the, or 15% is about what the S&P fell. So yeah, I would just wait until there's a bust. Just wait patiently, maximum pessimism till like 2000, something like 2001, 2002, what happened in tech stocks will happen in AI. And that's when I would want to buy.
Mm-hmm. David, do you have an outlook on Bitcoin and Ethereum somewhat as hedges against like currency devaluation as well, somewhat like precious metals?
I'm still a little suspicious. Now, Bitcoin, I will say, held up very well in the latter stages of that economic, that market sell-off in April. Now, the first part of the sell-off, when the sell-off was actually more muted, like in February into March, like it didn't act well at all, right? But then that second part of the sell-off, into about mid-April, it held up very well. And that's when you saw the US dollar dumping a lot. So I do think people were buying Bitcoin as kind of a way to protect themselves against the US dollar devaluation. The other ones, I think, are all risk-on assets. They're all like correlated with the NASDAQ. It's more similar to buying Tesla than it is buying a currency, right? Mm-hmm. So the other ones I think are all risk on. But Bitcoin, I think, will have some attributes as a currency. But with that said, I still think if we get a bad bear market, Bitcoin did fall, like I said earlier, from 110 to 80. You're going to see Bitcoin fall, especially because, like I said, I've always said this, the people that own Bitcoin are more likely the people who own NVIDIA and Tesla than people who own gold. Mm-hmm. So when those NVIDIA and Tesla start going down in price, if you get a margin call, you're going to have to sell your Bitcoin. So that could bring it down. And also, I don't see the Bitcoin ETFs as positive. I see them as negative, because being a gold investor, I remember in 2006 when like the GDX and the GDXJ came in. I was like, this is going to be great. These ETFs are going to buy all these gold stocks and push them up to the moon. Well, the exact opposite happened. Those ETFs attracted weaker hands. And then when the washouts came and the corrections came, people sold. And then all those ETFs had to sell all the stocks that were in there, where we were kind of like hodlers in the gold arena before that, because the people who own American Barrick or Newmont or Eldorado or whatever, they just kind of sat there in their little, like with their gold stocks, and they just held those for the long term. And those, I think those ETFs brought in weak hands and people that weren't long-term orientated. And I think the same thing's going to happen in Bitcoin.
David, one of the last chapters in the book is about green energy and rare earth metals. What is your apprehension around the adoption of many of these green efforts here?
The green energies? Well, like, okay, here's the thing. I'm not a big fan of the whole green energy movement and EVs and the whatnot. I do think we're moving in the right direction, EVs. Like, I don't know if you saw Jeff Bezos' new EV recently, right? Like, that's something that I actually liked. Like, I liked the way the truck looked. I was like, I actually would consider buying that. I hate Tesla. Sorry, no offense, Elon. and I know someone who owns one of those Porsche EVs, and he hates the thing, right? He wants to sell it, right? He lives in the UK. So, and you have the problems with the batteries and all of these other things, and then like solar and wind are more competitive now. But again, you're like, Germany right now is having problems because they've had this year where there hasn't been a lot of wind in Germany and they can't produce enough power. So you're subject to that. Like, I live in the Bahamas, so we're always going to be fine with solar energy, right? So like down here, like I'm going to put half my house in solar at some point because it makes sense here. So I think there's opportunities, especially because they're going to be pushed so hard. Like a company I like, which I talk about in the book, is actually a Canadian company called Canadian Solar, and it's going right back up to its 200-day moving average as we talk, and it's very cheap, and it's a very well-run company. They operate in the States as well. And obviously with Carney and Power, Carney is very pro all these green energies. I think that's something that can really benefit. So I like them. I think there's a place for them. I'm not a huge fan of green energy, but I know it's also going to be pushed hard. So, because of this whole, climate change movement. So I think there is a room for them definitely in your portfolio. And they're not overly expensive anymore. What happened was when all that money under Biden got thrown at those green companies in 2020 and 2021, in the wake of aftermath of COVID, and they were kind of doing stimuluses, these companies soared. Like there's a company I talk about in the book is really interesting, and then they've all collapsed. It's doing very well. It's called EOSE. It's a zinc storage battery company. So what's interesting with zinc is zinc obviously is a lot more plentiful than lithium. Lithium was kind of China was putting restrictions on lithium exports when Trump did the tariffs. It's mostly produced in China. We all know lithium is also very toxic, very explosive. I think one reason those California wildfires were as bad as they were, because there's all those yuppies in California own Teslas, and those things, when the fire spread, I have a friend who's a fire man, he's a fireman in California. He tells me, like, when one of those Teslas go up, you just can't put the fire out. It just burns and burns because of the lithium battery. So anyhow, EOSE is doing it zinc. So zinc, the batteries don't quite last as long and they take longer to charge. But again, it's more plentiful. And if you're just storing energy, it's perfect. And they've already made deals in Texas and California, EOSE. The stock went from $30 to $1. It's back about $6 now. And I think these are the kind of plays. This is interesting because, again, it's energy storage. It's going to be part of green power. Because one thing about green power is you want to store the energy when it is sunny, when you do have a lot of wind, at a wind power plant. You want to be able to store the energy, and the technology this allows you to store it, and then you can sell it later on. Maybe when there's days where it is cloudy or days where the wind dies down. So I think this technology has a lot of usage as well. So yeah, that's the kind of green energy company I really like.
Excellent, David. It's been a great kind of review or preview of the book. Again, I highly recommend it. It's not crazy long. It's written in such a way that it gives you the basis of what you need to understand many of these markets, and then actionable ideas based around, taking action to make trades in many of these spaces, if that makes sense to you.
And just to follow up, I have Profit with Pessimism. I have tiers of subscription. I have a basic tier. It's only $5 a month. That is just, I do a weekly video, and then I do more active trading in my regular subscription, which is $27. Mm-hmm. And by the way, with the purchase of the book, I'm also offering a $200 sale off my lifetime subscription. So it's for $700. Usually it's $900. So just show me a proof of purchase, and I guess the book costs like $30, so it'll really be, you're saving $170. But yeah, I'm doing that as well. And if you like these kind of trades on top of what I talk about in the book, I'm more active in the newsletter doing these trades as well.
Mm-hmm. Do you want to leave our listeners with anything to think about before we wrap up here today, David?
Yeah, I would really watch the bond market right now. I think that's the key market, because we've had this big, move because a lot of the tariffs have been dropped short term, and in the stock market, no one's looking at the bond market. But I think it's very interesting, again, that the 10-year bond yield isn't falling, even with the economy weakening, even with all that volatility in the stock market. And those bond yields continue to creep higher. That is very, very worrisome.
Mm-hmm. Excellent. Well, we'll keep an eye on that. And for anybody that wants to know more about the book or to buy the book, again, it's called Mega Returns: Profit for Maximum Pessimism, available on Amazon and everywhere you want to get books. David, thanks so much for your time today. Really appreciate it.
Yeah. Thanks for having me.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.